The political left always try to portray themselves as the good guys, they side with empathy and compassion for others.
You know, in general, the big question would seem, from at least some perspective, to just be a question of compassion. All systems are going to have errors. There's not going to be a perfect system. So to me, if you're going to have a system that's going to be in error, I would just, out of general compassion and being a nice guy, I'd rather have a system that errs, maybe treating people a little too kindly.
But despite the self-proclaimed nobility of the left's compassion, their empathy, when turned into political policy, always ends up destructive.
And this is why there's a book that's recently come out about empathy in politics, and says that empathy in politics is actually extraordinarily harmful. Because when you put yourself in the other person's shoes, you only care about the other person. You forget about the millions of other people that it affects.
And that's the problem with compassion in government policy. So when the left asks, what's wrong with compassion? What's wrong with being a nice guy? Well, by itself, there isn't a problem. The problem arises when that compassion is turned into government policy. Because compassion only requires focusing on those who the left decides deserves more empathy than others, and by focusing the spotlight on them, the left neglects all other casualties of their bad policies. And Americans have already been hurt by the left-wing need to be the party of compassion and the bad policies they produce, because compassion pays no attention to the actual results. Having empathy and compassion doesn't require rationale. It doesn't require good decision making. It doesn't require anything but feelings. For example, compassion-driven politics said that people who can't afford homes and don't have the credit to buy a home deserve to own homes anyways. Why don't you want poor people to own homes, they say? Do you want them to live on the streets? Have some compassion. But then many of them defaulted and the economy crashed.
Back in 1977, Democratic President Jimmy Carter passed the Community Reinvestment Act, which was designed to put money back into poorer neighborhoods and communities. Not a bad idea. However, over the years, the government eventually forced banks to write mortgages to people whose credit and income would not otherwise have qualified them back in the good old days of sound and reasonable risk-reward calculations. Now, when the government essentially guaranteed bad mortgages, they completely changed the incentive structure of banking. Banks no longer cared about making sensible loans to people who could pay them back because the government was going to pay off even the bad loans. So now the smart play for a bank is to write as many mortgages as possible. And when Republicans repeatedly pointed out this growing danger throughout the mid-2000s, Democrats called them racists who hated the poor.
There was the Community Reinvestment Act, or CRA, passed in 1977 during Jimmy Carter's first year in office. The law increased oversight of financial institutions to ensure that they were giving credit to low-income families.
We're going to make sure those banks do it and they don't discriminate. But the law went overboard. Institutions made loans they probably didn't want to make because they couldn't seem racist.
You can really go back to the Community Reinvestment Act of 1977, which was saying that the banks weren't lending enough money in their own immediate community or in all communities. But as time went on and as they began to get studies done indicating that blacks were turned down for loans more so than whites, then of course they're energized and immediately there's a crusade to clamp down on the banks, tell them who they should lend to, require them to keep records, the income and race, sex, everything of the people. And if the profile of those they lend to don't please the politicians, they're in trouble.
Last year, the Federal Reserve Board found African Americans are denied credit for homes at twice the rate white Americans are. SACU Bank in Texas. Discrimination in lending, discrimination in rendering mortgages. The bank has agreed to change its practices, as you heard from the Assistant Secretary. The bank has also agreed to a $2.1 billion agreement where they'll make $2.1 billion available to families who are low and moderate income across the country for mortgages. About 15,000 low and moderate income people will now be able to buy their own home for $2.1 billion that would not have been available to families of low and moderate income. About 15,000 families, we estimate will get mortgages who would not have gotten mortgages otherwise. They would not have qualified but for this affirmative action on the part of the bank, yes. Lending that amount in mortgages, which will be a higher risk, and I'm sure there'll be a higher default rate on those mortgages than on the rest of the portfolio.
They encourage banks and other lending institutions to make loans to people that the banks and lending institutions themselves would not have done. They would not have taken on that level of risk.
The economic crisis facing the nation is due in large part to this disastrous decision by financial institutions Fannie Mae and Freddie Mac to buy up risky loans from small banks. But it's groups like Acorn that forced those banks to give out those loans in the first place. Back in the 1990s, they used strong-arm tactics to force banks to give high-risk loans to low-income borrowers with bad credit.
Acorn uses militant tactics. They call it direct action. Sometimes Acorn will actually send people to a bank official's home. They'll scare him, they'll scare his kids.
Historically, responsible homebuyers and shrewd banks bargained until they found common ground. Home buyers wanted the best rates possible. Banks wanted their money back. But that equilibrium was disrupted when politicians decided that government should
try to make the dream of homeownership more achievable.
While at first Fannie actually resisted buying up some of those shaky mortgages, at the tail end of the Clinton administration, Fannie Mae was told to substantially increase the percentage of those mortgages in its portfolio.
The federal agencies pushed the lenders and pushed Fannie Mae and Freddie Mac into making more risky mortgages because they had this mantra of affordable housing.
Why were the housing prices artificially high in that handful of markets?
Because despite the abundance of land in California, laws prevented people from building on much of that land and made it prohibitively expensive on the rest of the land, so that the housing prices were shot up primarily because the land on which the houses were built were tremendously expensive.
So the whole open space movement.
Oh, yeah.
I quote you again. Some of the least knowledgeable and least experienced home buyers were now financing their purchases with some of the newest and most complicated mortgages.
Yes, because the whole notion was that you wanted to make housing affordable to people who otherwise couldn't buy, which meant low-income people, often people of limited education, people who had never bought a house before. And so they were presented with these complicated mortgages that often began with very low initial rates. So you'll pay $500 a month for this house, but in 6 more months you'll be paying $800, and then at the end of a year you'll be paying $1,200, and 2 years later you'll be paying $1,500. Well, not everybody may have understood all that.
Construct the layers of the problem. Specific housing markets in the United States, coastal California being one, where largely because of government interference in the first place,
yes,
if that's the correct way to put it,
yes,
the open space, artificial or government-imposed restrictions on land drives up land prices. People in those housing markets become desperate. What step is next? Institutions begin lending to them newer and more creative kinds of loans, but there's a step here. Somebody's encouraging those institutions.
Oh, absolutely. Not more than encouraging. The government required people by the 1990s to supply data on the people to whom they were lending, the race, the income, the communities in which the people were located. And if those numbers didn't suit the government, the banks could have great trouble getting government permission to do things that other businesses can do without government permission.
Following the law of unintended consequences, the people hurt most by the bust were the ones that ownership was supposed to help.
Blacks, Hispanics, other minorities, those are the people who were hit hardest. They were most likely to have to go into default. Unless the person got a 0 down payment loan, they put some money into the house. And now when time comes when they can't pay the mortgage, they lose all of that as well as having to move out.
But why did people who didn't meet the standards set by banks, subprime borrowers, get loans in the first place?
It was the regulators who insisted that the banks lend money to people who didn't meet the standards that the banks had always used. And so this then forced the banks into finding new ways of lending to those people. And so therefore, instead of having the 30-year fixed mortgage with a 20% down payment, which most of the people that the regulators wanted them to lend to didn't have any 20% down payment.
Some politicians were the biggest cheerleaders.
When the boom was going on, Barney Frank was very willing to say publicly that he was pushing. He said, we haven't pushed enough to get them to lend more, to do more for affordable housing.
In a November 30th, 2006 interview with PBS Nightly Business Report, Barney Frank was asked,
what's your top priority? Affordable housing is the single biggest one. We have a terrible housing crisis in this country, and I think we now understand that housing is not simply a social good, but it's an economic factor. The biggest difference people will see when we take over from the Republicans is we will reverse their policy of basically letting any affordable housing stock dwindle.
Now that the music stopped and the bubbles burst,
Mortgage foreclosures reach an all-time high.
are the politicians saying, sorry, we made a mistake? No. Now they tell us government must do more.
The federal government must implement a program.
That's very much like you see a building on fire. Would you call the arsonist who created it to help you put it out? No, you wouldn't. But we're calling on Congress that created the problem to help us solve it.
Subprime lending started off as a good idea, helping Americans buy homes who previously couldn't afford to. Financial institutions created new financial instruments that could securitize these loans, slice them into finer and finer risk categories, and spread them out among investors and around the country. In theory, this should have allowed mortgage lending to be less risky and more diversified.
The original idea was a good one.
I want to pause here for a second and highlight how Obama says the original idea was a good idea.
The original idea was a good one.
Because that mindset is exactly why the left's compassionate or empathetic policies always end up being destructive. This idea of forcing financial institutions to make stupid loans was never a good idea, and the disaster that came afterwards that devastated the economy is proof that this was a terrible idea. It may be a well-meaning idea with good intentions, but that does not make it a good idea. But this is what the left does when their compassionate policies inevitably fail. They will say that it was a good idea in theory, just not well executed. So it wasn't the idea was bad, it's just we need more oversight and regulation the next time and it will be fine.
Now, after the whole thing blew up, then Barney Frank is saying, this is all due to too much reliance on the market, that what we needed was more regulation. Well, yes, you could use better regulation, but the regulation that we actually had was itself at the heart of the problem.
Financial analysts are saying that if mortgage giants Fannie Mae and Freddie Mac had been effectively regulated years ago, the supercharged subprime mortgage meltdown that led to the current financial mess would either never have happened or would have been nowhere near as severe.
The cause, say the presidential candidates, greed and lack of regulation.
They said they wanted to let the market run free, but instead they let it run wild.
Democrats say it's the administration's fault.
Deregulation and failure to regulate has been one of our major problems.
That was the Bush view. Don't regulate anybody.
Bush removed all the regulations and let these people run wild.
That claim is absolutely false.
Jonathan Macy teaches corporate law and finance at Yale.
People can blame George Bush with doing a lot of things, but deregulating is not one of those.
There was no real deregulation during the Bush years.
In fall of 2003, the Bush administration was pushing Congress hard to create a new federal agency to regulate and supervise Fannie and Freddie, both government-sponsored enterprises or GSEs.
We need a strong, world-class regulatory agency to oversee the prudential operations of the GSEs and the safety and the soundness of their financial activities.
But then Treasury Secretary Snow was getting a lot of pushback from then-ranking member, now chairman of the House Financial Services Committee, Democratic Congressman Barney Frank.
Fannie Mae and Freddie Mac are not in a crisis.
In fact, Frank said the federal government should be encouraging Fannie and Freddie to do more to get low-income families into homes. And he believed too many people had a sky-is-falling mentality. But the two mortgage giants had staunch defenders. Democratic Senator Charles Schumer said, quote, I think Fannie and Freddie over the years have done an incredibly good job and are an intrinsic part of making America the best housed people in the world.
These are sound. These institutions are in sound shape. Things are good in the housing market.
I think we see entities that are fundamentally sound financially.
The legislation was blocked.
Virtually everybody threw up a red flag. I even did a piece in the Wall Street Journal in 2005 saying, this whole thing could collapse like a house of cards. But more important, Alan Greenspan and others, the head of the Federal Deposit Insurance Corporation warned them. The Secretary of the Treasury under Bush warned them. Fortune magazine warned them. Barron's warned them. The Economist magazine in London warned them. Everybody and his brother told them this wasn't going to last. They didn't want to hear it. And there was, whatever the risks were to the taxpayers and to the economy, there was virtually no risk to the people who were pushing this.
Let's consider a few of the public officials involved here. Congressman Barney Frank of Massachusetts speaking in 2003, quote, "I would like to get Fannie and Freddie more deeply into helping low-income housing.
Yes.
I want to roll the dice a little bit more in this situation towards subsidized housing," close quote. What was Congressman Frank thinking?
He was thinking of getting reelected. Because when you do favors of people, those people are more likely to contribute to your campaigns. They're more likely to vote for you if they're in your district.
Now, Barney Frank, George W. Bush, Alan Greenspan. Of those three, who was the worst actor?
Oh, Barney Frank easily.
Okay, and of those three, whom does the press still listen to? And
Barney Frank.
Thank you, Tom.
So, Democrats caused the problem, then Democrats took credit for solving it, which, as near as I can tell, is in fact pretty much the entire history of the Democratic Party.
The original idea was a good one.